Good morning, good afternoon, everyone from La Jolla, California, where we have some rain this morning. So it's a rainy day in La Jolla. Obviously, we're also gathering during a very interesting moment. This is Jeremy Martin, Vice President for Energy and Sustainability, and we're pleased to have the latest installment of our energy webinar series focusing on a topic that has been obviously gaining importance, but I think in the last couple of days, with all the focus on the turmoil in the oil markets and some of the back and forth with OPEC and Russia, it brings even to more attention on some of the intersections of the oil sector in the medium and longer term. And I think the implications for Latin America, particularly when we start talking about some of the more recent developments in the countries that are pushing deeper out and offshore, and some of the complexities and longer term nature of those projects. We're very pleased to have this webinar and have our featured presenter, Jed Bailey. Jed is probably someone most of you have known for many years. He spent a good bit of time running Latin America for CIRA or IHS, and then left and has for almost 10 years been on his own as the managing director of what's called Energy Narrative. And similarly, I'm sure many of you interacted with Jed since he's launched Energy Narrative, particularly in Mexico, but more recently in the Caribbean and Southern Cone and Andean regions. And I think Jed's the perfect person to help us look at this intersection of oil and climate change. And obviously, there's also been, in addition to sort of the more recent last couple of days or so, turmoil in the energy or the oil market. Before that, there's been some very interesting developments by the industry, by the new leadership at BP, with a very clear objective for 2050 to go to net zero emissions. And then obviously Shell and everyone always cites Equinor and everything that's going on at that company with regard to how the company's positioning itself and the broader energy transition contours, and moving from a oil company to an energy company, and some of the things that they're doing as well. So I think there's a whole host of topics. And then when we drill down to Latin America, which Jed will do in detail here, and we look at what's going on in Brazil, where they've made huge gains, but on the back of complex offshore deep water projects that take a lot of time and cost a lot of money to develop. And more recently, the first oil in Guyana is a huge event for the region this year, and continue to have impact and perhaps propel Guyana into the top 3 category in the not too distant future in terms of the oil production outlook for the countries in the region. So anyway, I don't want to belabor the point, but I want to set the table for Jed to share with us his thoughts on these topics. And let me just finalize my comments with a reminder and an indication for anyone who has not joined us before. Jed will do a formal presentation of about, 25, 30 minutes, depending on how much he wants to get into some of his slides. And then we'll reserve some time at the end for discussion. And this is obviously where we encourage you all to participate and jump in with your questions. And the point is, you don't have to wait until Jed's finished with his formal presentation. You can immediately participate by way of the chat function. If you see down in the right-hand corner, I just wrote the word question. Rafael, greetings to you from the U.S. Oh, thank you for joining us, and good morning from Mexico, Jose. Good morning from La Jolla. So some of you already found the chat function. Thank you. Please also use that, like I said, during the course of Jed's formal presentation to pose your questions. You don't have to wait till he's done. So that's my introduction. I don't think that took 10 minutes, but anyway, now it's over to Jed Bailey to share with us his formal remarks. And like I said, hopefully an interesting question and answer session. I think there's a lot of material here, and hopefully we can cover a lot of ground. So Jed, thanks again for joining us and preparing some remarks as part of our webinar series here at the Institute of the Americas.
Excellent. Thank you, Jeremy. I appreciate the opportunity.
We'll try and get Jed.
There we go. Excellent.
There we go.
Very good. So as Jeremy mentioned, my thought was to share a few thoughts with you on the climate change debate and climate change issues and how that will affect the oil sector, and in particular in the context of Latin America and the Caribbean. So to frame the subject a little bit, just to make the point that there's obviously been concern about climate change going back decades, all the way back to the Rio conference in 1992 and before. But I would argue that the subject and concern has matured to the state now that it's moving away from being a health, safety, environment type issue or an environmental, social governance, investment type issue to becoming increasingly a CFO type of an issue for companies and consumers and governments alike. And it has been intriguing to me to watch the almost the generational aspect of this shift in concern and focus, because it reminded me back in the day how attitudes towards smoking changed. You know, when I was a kid, all the TV shows and movies showed the heroes and the good guys were all smoking because that was the cool, sophisticated thing to do. And during the course of growing up, that changed dramatically. And so now, indeed, if you have smoking shown at all in a movie, it creates you a higher and more stringent rating from the movie rating agencies because it's considered such an antisocial behavior. So I feel like there's parallels there to the attitudes toward energy use, and in particular fossil fuel use, its role in the broader energy matrix. And one sort of way to highlight that, as I'm showing here in the graphics, Energy Narrative puts out a weekly brief, one for Mexico and one for the greater Caribbean region. And in those weekly briefs, we have a number of blurbs that cover the latest news of what's going on in each sector. And so going back over our archives of around over 5,000 of those for Mexico, maybe half that number for the Caribbean, I just did a quick search on how many mention oil, gas, solar, wind, or all renewables, the rest. And as you can see from the graphics, within Mexico, focus on oil and gas has declined considerably over the last few years, such that the total number of articles written about renewables has surpassed those for both oil and gas in the past year. And a similar trend in the Caribbean, although we don't have as much history, with renewables taking on an increasing focus, oil coming and going in part with Guyana's fortunes, and then the interest in gas dropping precipitously over the last year or two. And I think that's reflective of the broader trend of the industry and the global economy in general. And as all of you know, that's supported by a lot of hard facts as well. You know, as we see key technologies, especially the cost for solar PV panels, lithium-ion batteries, are all pushing greater decarbonization, reduced use of fossil fuels, move toward electrifying transport, and all of these that make up the broader energy transition. And intriguingly, it's not a top-down story like I think it would have been, say, 15, 20, 30 years ago when concerns about climate change first arose. That was the eras of pushing the very high-level framework convention on climate change at the Rio conference, where international coordination was seen as the only way forward. And while that's, I think, failed to live up to a lot of the hopes, it has now, I think, been partially replaced by a lot more action at the city, state, the individual, and the corporate level. So the bottom line that I'm sort of getting across with this graphic and this chart is that the energy transition and this focus on climate change mitigation and adaptation is here to stay and one of increasing importance for companies across the energy sector, whether you are directly involved in fossil fuels or renewable energy or not. But even so, given that, when we think about what's actually happening with oil and oil companies, there are a few difficult truths that you need to be aware of before you write off the idea that no one will be consuming any oil whatsoever in the very near future. True, transportation is by far the greatest use of oil, in particular for personal vehicles, as well as aviation and shipping. But it's not the only use. So if we look at the graphic here, we're showing how a typical barrel of oil is split here in the United States. A lot of it for transportation, heating, those types of industrial uses. But around 20% or so is used as feedstock, particularly for petrochemical, other precursors, and plastics, and other material uses that really touch on everything across the economy. Everything from shampoo and toothpaste to every single plastic piece that you touch to other larger industrial and consumer goods. So oil is much more than just a transportation fuel, and removing that use for oil, which has less of a carbon impact since it's not being burned, becomes, I think, more difficult. Certainly, there are non-oil alternatives that are available. Those alternatives will likely become cheaper in the future, but this is one of those uses for oil that doesn't have a direct climate impact through its burning, and therefore may be on the back burner to be pushed out as the final use and demand for oil. So therefore, I would argue that oil demand will persist even if we do move toward a net zero carbon world relatively quickly, and relatively quickly over the course of decades, certainly. But the size and shape of that demand, of course, is certainly up for debate. And that's where I think a lot of the discussion is today. And not so much zero oil, but how much? Is it vanishingly small, or is it as large as this 20% number that I show here? Add to that the fact that, as you are all very familiar with, oil wells naturally decline. So once you start producing from an oil well, each year it will produce a little bit less over the course of the natural life of that well. And so if you combine that fact with the fact that oil demand will continue in some way, shape, or form, then you get back to the requirement that some new investment, some new exploration and production is going to be required for the foreseeable future if that lingering oil demand is going to be served, which means oil companies will still exist. By definition, if a company produces oil, that's an oil company. Is oil the only thing they do, or even the majority of what they do? Perhaps not, and I think that's a debate we can look into in another call. But certainly, companies producing oil, in my view, will continue to exist for quite some time. Now, to get to the point that I wanted to make on this particular discussion, how that oil supply is met will be very interesting, because the options for producing oil from the range of different reservoirs and different technologies through the different types of companies that produce them and the different geographies in which they produce is very wide. And there's a huge range in those costs and time requirements that will, I think, benefit some and hinder others as we shift toward this new supply and demand landscape over the coming decades. Just a little bit more detail around that. I'll spend a little bit of time with this graphic, and shout out, I pulled this from a publicly available report by Rystad, another fine consulting firm that I'm sure many of you are well aware of. But this puts their relatively recent view on the average cost break-even price per barrel produced for different producing regions around the world. So they lump all the current producing fields into a single number of around $26 for break-even, which suggests, at least on average, even after our recent price collapse, somebody's still making some money with the existing fields. But then looking at the break-even cost for new development from the relatively cheap onshore Middle East up through the very expensive oil sands, you get a pretty wide swing. In fact, the oil sands showing to be almost double on average of what the average of the onshore Middle East for new production would be. So a huge swing in the total cost across those different technologies and different resource options, including toward the left side there, the North American tight liquids. And so these are the shale oil and other tight oil options here in North America that have seen such a strong surge over the last 5 years or so. According to Rystad's analysis, average for that grouping is somewhere around $46 a barrel break even, but with a range that goes slightly toward the $30 range and perhaps as high as 50 or so. Again, a number of those projects likely to continue to go forward even in today's price environment, but by no means all. And we can talk more about the impact of that on near-term shale oil supply from the U.S. In a minute. Looking at the deep water, which is the other extreme that I'd like to chat on a bit, it shows a significantly higher average cost, but a range that's not significantly different. The lower end of the deep water price there is not too much higher than what we're showing for shale oil, although the average is certainly higher, suggesting that the larger fields are on the more expensive side, and the upper range there pushing somewhere around the $6 per barrel range. So for costs, comparing those two, you've got a bit of a range, but a significant amount of overlap. The other aspect, though, that is of critical importance is the time required for development. And here we see a much wider difference across those two bookends and across the various technologies in general. So I'm showing in the timeline there at the bottom just a generic view of, once you're out there looking for oil in a province that you believe shows promise, how long would you expect that product to last? And again, very rough, very broad country numbers. The exploration where you discover the field, drill the discovery wells, find what's there, and then evaluate the actual resource base can be anywhere from 5 to 10 years if you're talking about a new province or a new play. And so the years it takes to drill the wells, get a few dry holes possibly, evaluate what you do find, get a sense of the delineations of the field and the rest, and finally come to an investment decision at the end of those 5 to 10 years that yes, this is a resource base that's of sufficient size and sufficiently low cost to make it make sense to develop. Then the actual development from when you first start drilling production wells through first oil being produced, again, can be anywhere from 1 to 5 years. Once they do start producing, the typical production profile tends to try and spread that across, say, a 15 to 30-year period. Often, producers try and push that development as early in the time frame as possible, but there's always a little bit of oil that can be developed from enhanced oil recovery and the rest, which can extend the life of those fields for a very long time indeed, before you get to the decommissioning phase. And so again, to look at that in our framework of these two bookends, the North American shale plays and deep water, are at the two extremes of these. On the shale plays, especially here in the U.S., for most regions, the known resource, its location, and the rest is quite well known, and so there's very little exploration required. The shale development process is almost more of a cookie cutter factory process of moving the drilling rigs, hammering out the production wells, fracking them in the various techniques they use, and then moving on to the next and then cranking those out one after another after another. And so the actual development process can be as little as a few months to, say, a year and a half, something in that range, depending on available infrastructure and the rest. However, once they produce, they tend to produce quite quickly as well, and then you move on to your next well. Whereas for the deep water, it's a completely different story. Even securing rigs can be difficult in times of very active industry activity in the deep water areas. Having the rig available, drilling the holes takes longer. Deeper, more complex operations. Development and deciding on the specific concept to use and how to then procure all of that takes many years. And then finally, the production tends to be longer because you don't go through all that trouble unless it's a really big, really long-term potential. So the production would be pushing the longer end of that 15 to 30-year period. So those two give you sort of the broad range of development. Now, what does all of this mean, for example, for considerations in this context we have of climate change? So as we're showing here on the next slide, I'm comparing the two technology or two resource examples I brought up, a shale well, presumably a North American shale well, and then a generic deep water discovery. So this is a field that has just been found and requires the development and delineation and the rest early on. So we're showing in the graphic, if, say, each of those wells were discovered today in 2020, the shale well development is very straightforward. Drill the well, frack it, get the oil almost immediately, but then have a huge decline curve. Many of these have decline rates of 40 to 60% per year. And so your peak production comes almost instantaneously, but then wears off very quickly over a few 3 to 5 short years. And then you have this long tail that can trickle out but is much smaller than the original production levels. Compare that to the deep water, where I've built in 5 years worth of development to delineate and further define the opportunity, another 4 years to actually build and develop the production concept itself. So first oil coming around 2028 to 2029 in this particular aspect. Ramping up over a 2 to 3 year period to its peak expected production, remaining there for a number of years as long as the reservoir engineers can maintain it, and then slowly moving into its decline rate of around, I have here a 5% based on an industry-wide average, but of course each field would be different. Very long decline in discovery over the next several decades before finally decommissioning the field somewhere around 2060, in this case around 30 years from first oil. So very different profiles for production, very different aspects of capital costs and the rest. And I highlight a lot of those in the table to the left. So while shale wells can be developed very quickly, the deep water is quite slow. On the flip side, however, the shale well depletes very quickly, while the deep water project would have a much slower depletion, a much longer production period. The issue of scale as well, with a shale well costing in the few millions to perhaps even less to develop versus the tens to hundreds of millions for a deep water concept, results in very high capital requirements up front, but also very high oil produced from the deep water versus what you would expect from a single shale well. And all of those variations, especially the speed to development and the capital requirements, puts very different sensitivities on those two options. So you have in the shale well case a very high sensitivity toward current prices. Because the drilling and the fracking process can go so fast, and because often, especially in the US plays that have been developed in the last year or two, the main constraint is access to the gathering and distribution and essentially the pipelines to bring the oil out of the fields and into the main pipeline system. Those developed but uncompleted and developed but under unconnected wells can sit for quite some time waiting for the right moment before they can enter and actually serve the market. And so as a result, they can have extreme price sensitivity toward the huge swings in market oil prices like we've seen in the last few days. And again, as I noted, although some of those developers are certainly able to work at oil prices like the levels we see now, the vast majority are going to have a lot of financial pressure in the near term, will be slowing or delaying their production to the extent that they can, and you'll expect to see a related impact on U.S. oil production quite rapidly. And this is part of the broader story we've heard for many years of how the U.S. can play this role as an oil swing producer based on price, which it was not playing certainly in the past. Now compare that to the deepwater discovery, where price swings today, if we're using this hypothetical discovery that was made just this year, have absolutely no impact whatsoever on the final decision to invest in this, because you won't make that decision for another 5 to 8 years at a minimum. And even then, should say there be a lot of price volatility at the time that the final investment decision is made, it still has less of an impact on that decision because the production will be spread out across such a long range of time. Looking at historical price trends, the assumption would be prices come and go, they rise and fall, they can be volatile, but on average, here's what we've seen and here's what we would expect. And as long as that average or that forecast is sufficient over the life of the project, whether there's any months or weeks or even a year at points where the price is too low, you know that will be balanced out by weeks, months, or years in which the price is much higher. So these kinds of projects, they will have a price target that they need to meet and ensure that their total cost of development spread out over the total barrels produced is able to come in under that hurdle, but the actual shorter term price volatility has much less of an implication. However, given the long time frames, it increases their exposure and risk to exactly the energy transition type of dynamics that I discussed earlier. So if we turn back toward the graphic, as I'm showing here, it's showing the time frames for the development, but then below the graphic, I overlay some of the high level, country level policies that are now being put into place to enact this energy transition. So for example, many countries are now developing plans to phase out internal combustion engines and shift vehicles to entirely electric fleets, at least for new vehicle sales over, say, the next 5 to 15 years. So we've seen several countries, the most aggressive, suggesting no new internal combustion engine vehicles will be sold starting in 2025, while others push that number back toward 2040. Some are even suggesting outright banning the use of internal combustion vehicles between the 2030 to 2040 timeframe. So this is a time period when certainly growth in transportation use of oil will be affected by these phase outs and potentially start seeing structural declines as more and more countries take on these targets. Certainly the critical question will be to what extent the United States, China, and other emerging markets join in with what has primarily been either very small nations or European countries in suggesting these phase outs. But it is a trend that I believe will continue and continue to grow as the years go forward. Layered over that, we have the even more ambitious goals of countries moving toward net zero carbon targets. And these are ranged between 2030 to 2060, with the vast majority clustered around 2050. So it's a number that, from a political standpoint, is ambitious enough to show that you're serious, but far enough in the future to not have to worry about it too much personally. And so I would say the critical question for the next several years, to say 5 years or so, will be to see what level of detail and what specific policies start to be developed to make those very high level promises become much more concrete commitments. And again, I think the world is certainly moving in that direction. The question is how quickly and with how much investment and government money behind it to truly enact those. But for the purposes of this discussion, if you look at that 2050 number, again, it's a good 30 years out in the future, but it's still well within the production profile of this hypothetical deep water discovery that we have from this year. So even something as far out as 30 years can have a direct impact on how this discovery and the market that it is feeding into evolve into the future. Because again, note that if a country is to reach net zero by 2050, it will need to be moving in that direction significantly far before that. And so total oil demand should be declining quite rapidly, at least 10 years, I would say, before that, if not more. So for the majority of the time that this deep water discovery is producing, you see demand shifts either shifting geographically as countries that do not have those targets become a greater share of total oil demand, or declining structurally if the majority of the world gets on board with the targets of net zero, and we see overall oil demand declining quite rapidly during that period. So, spend a fair amount of time on this graphic. I'm sorry, just a quick note that to put a little bit more pressure onto those numbers, the small green bar there is the range between 2050 and 2052, when the IPCC and others had suggested we need to get to net zero in order to contain global warming to a 1.5 degrees C increase. And there's clearly a lot of uncertainty and fudge factors around those numbers, but it does give a sense of the range we're looking at. And again, that is well within the production profile of this deep water discovery. So move down then to my last slide, where I'll spend a bit of time here as well. What does this mean for future oil development? And again, just some high-level thoughts on what those trends and what those differences might possibly imply. So first, a broad view. Oil markets entering a new era of extreme uncertainty in demand, price, regulation, and consumer sentiment. And that, I think, encapsulates each of the points made earlier in the slide, and I think is important to highlight because this is a combination of uncertainty across multiple different factors that the oil market hasn't had to deal with. Huge concerns or uncertainty about demand growth, whether it's higher or lower, but not necessarily a structural global reduction in oil demand. Concerns about price and price volatility, as we have seen in spades the last few days, certainly, but never an overarching view that perhaps the lack of demand for oil could suppress and collapse prices to such a degree that large segments of the oil supply picture are just simply not economic. And then questions of regulation. Environmental regulations have always been a part of the industry, but regulations that make the product itself unviable are a relatively new thing. And consumer sentiment, and this gets back to the point I made earlier about a generational shift. I think there's a definite view that energy consumption, and especially conspicuous consumption, is less a mark of sophistication and status, less today than it was certainly 10, 20, 40, 60 years ago. And that shift in consumer sentiment and desire for green products, green energy, and the rest, I think will continue to grow. I would add, however, I think there is still, excuse me, a lack of education across the broader consumer base as to just how deeply involved oil is in many of the products that are currently bought. But that's an education process that will be ongoing, and that certainly clean products and clean energy providers will be more than eager to help educate consumers about as we go forward. As a result, these complex, long-term, very high capital cost developments like the deep water example that I showed earlier, any of those that start today will begin producing in the midst of the structural market shift. And they will be producing throughout the structural shift, and will have to deal with that shift and the uncertainty throughout the life of that asset, which means that the company that's making it has to take that into account before it makes a final investment decision. And so it requires an FID in an environment of uncertainty, I think, unlike that most oil company executives have had to deal with up until now. And that is for an oil discovery, say, that was made this year. For companies that are out prospecting with the idea that perhaps we'll find the next big thing in some of these resource basins that are underexplored. USGS has identified as having significant resource potential, but just hasn't been either drilled or the seismic hasn't been shot yet. That's a further delay that may make those types of very complex long-term projects even more vulnerable to the changes that come. Because every year that you wait before the discovery is another year in which that production profile is pushed into this transition zone, and then the future of a very low oil demand environment. And so as a result, we see investor pressure perhaps already affecting capital allocations. So for example, there's been the divestment movement among a number of institutional investors, similar to other divestment movements in the past, in the sense that they don't want to invest in companies that may not have the long-term growth or profitability rates that they have today, and therefore may see stock prices or prices declining in the future. You also see increasing use of internal carbon prices for final investment decisions. And again, I think the majority of oil companies will already use a shadow carbon price as they estimate what the impact of carbon policies may be. As we go forward year by year, I would expect those shadow prices to increase, or the other expectations for carbon restriction, carbon sequestration, and capture requirements to be increased, which makes final investment decision more and more difficult for these longer term projects. To move that away from the company and the individual market perspective, and think, what does this mean for countries and other regulatory regimes looking at how to attract investment or how to manage their oil sector? A few observations there as well. And then again, thinking specifically about Latin America, you see countries like Brazil, Mexico, and I would include Guyana, that have deep water developments that are already in the works. Guyana is certainly the most recent person to come to this party, a recent country to join the party. But with Liza 1 already producing, I've lost count of how many additional wells that are already proven up through Exxon's drilling program. Guyana's got a lot of knowledge and perspective on what's available and what can be developed, which will shorten up that development time frame for new development of the wells that it's already known. So Brazil, with its very well established offshore, Mexico moving forward with Tryon and the others that were auctioned off just a few years ago, they're already partway down that road. And so I would expect to see those investments continue, and additional investment in related fields or other areas that can tap into the same infrastructure, or have other ways that it will shorten down that development and evaluation time to get more quickly to the production, have the greatest chance of moving forward in the years to come. I would say those countries or regions that have offshore potential but have either not completed the basic exploration or resource delineation operations, that don't have detailed seismic available for investors to review, will have an increasingly difficult time to attract that investment, just because the uncertainty becomes that much greater as you push the time frame out. And I think there are certain areas within Mexico's deep water that I would include in this regime, in this category. So areas where there is likely potential, but more information is needed, more investment is required to clarify exactly what the potential is, and a more challenging infrastructure situation. Those areas that are further away from the U.S. And Mexico maritime border, and therefore see greater challenges to tapping into the vast amount of infrastructure that's already in place on the U.S. side. I think we'll see increasing difficulties. And so from this perspective, if you think about the auction process that was put on hold by the current Mexican administration, I think there is a chance that they are permanently closing the window on certain blocks or areas that could have been offered if they had been offered a year or two ago, but will be much less interesting if they're instead offered a few years or 5 years from now. I think you can see similar questions in areas in Brazil that have seen less offshore development, although the critical areas, offshore Rio and Santos and that have seen significant development in the past will remain attractive. And finally, just a few points on tight oil and what it means for U.S. and potentially other countries like Mexico, Colombia, others, parts of Brazil that potentially have tight oil plays. I think that far end of the spectrum becomes increasingly attractive, especially if we see in the far future decline in current production outpacing the decline in oil demand. And so if we do see potential for a tightening market there, it's those projects that are more toward the tight oil side that I think will first see new investment capital coming in, because it can produce rapidly, and because it is more responsive to short-term market swings and less exposed to long-term uncertainty and trends. Having said that, however, that is a picture of a much more volatile market, one where you see events like today much more frequently, where the imbalances between supply and demand get out of whack more frequently, and you see the response from groups like the U.S. Shale players uh, being delayed by a year or so, but ultimately coming back and rebalancing the market and perhaps overinvesting as well. So one where you don't have as much of the long-term projects that are less price sensitive, and one where you see a lot more back and forth between the impact of a price collapse on investment or the impact of an investment surge on rising prices. So with those thoughts, I'm very happy to move toward any questions that you may have. As Jeremy mentioned, I've been running Energy Narrative for close to 10 years now. In addition to consulting work, we do put out a news bulletin that summarizes the energy news for Mexico and the greater Caribbean. And we're looking forward to launching 3 new services to cover the Andean, Brazil, and Southern Cone within the next month and a half. So with that, looking forward to your questions. And I believe, Jeremy, will you moderate?
Yeah. Let me. In fact, I'm gonna. Thanks you so much, Jed. That's fantastic. There's so many points I want to come back to, and I see we've already had one question here. So just a reminder: use the chat function, and we've got about 15 minutes here. Definitely look into the newsletters. I've been reading the weekly brief on Mexico for years now, and it's great. I can't remember if it's Sunday night or Monday morning, maybe some cross between.
Yeah. Early Monday, very early Monday.
Inbox. So there's certain things I want to clarify. Early Monday, there you go. Because I think there's so many interesting things you've laid out here for conversation. Let me just kick this off with 2 questions, and then I'll start reading some of the ones we're receiving and pose those to you. Without trying to put words in your mouth, it seems to me, and the question will be clarifying my statements here, Jed. On stranded assets, I'm hearing you say that this, which forever has been very hypothetical, seems to be turning into a more clear reality now. I really derive that from a couple of your graphics. So I'd like you to comment on that. And then related, am I correct in assuming that you're arguing that climate pressures and demands are going to increasingly favor shale plays over deep water projects in the next 10 years or so? So a couple thoughts to chew on, and then we'll get into some of the participant questions.
Sure. Yeah, no, and certainly. And I should say, so the question on stranded assets, and certainly whenever I think of stranded assets, I think of the power markets, right? Because that's where much of my work in the past has been in gas and power. But in the case of oil assets, it's I think a bit different. So when I hear the term stranded assets, I immediately think of a power plant that's outside the dispatch curve and therefore is not being run whatsoever, is making no money, and is going bankrupt because it has no way to make cash. That's not the same as thinking about a stranded asset in the oil sector, where for the most part, a huge amount of investment and capital comes very much upfront, and oil that's produced can be sold. It's just a question of it's being sold at a price that allows the full recovery of that capital. And so I would argue that yes, going forward, there is an increasing risk of especially very large, long-term, capital-intensive projects of seeing the total amount of revenue that they make over the life of the project. There's an increasing risk that revenue will be insufficient to meet the investment and return requirements that the company expected when the investment decision was first made. So, having said that, and that was kind of a convoluted answer, the reason why I think that's important is because I know that was like, I'm sorry, my inner politician was coming out for a second there. But the reason why I think that's important is because for individual oil companies, that's a huge deal because it depends if it's a factor of whether they're profitable or not. For investors, it's a big deal earlier on because they need to understand that before they make the investment and understand how all of that dynamic will affect stock prices and how stock prices will change. But from a consumer perspective, it's not the worst thing because the oil is still being made available, and it's still there to meet whatever demand is needed. So I would say you could see a range in the future here where, from a company perspective, the world is getting very bad, and you see bankruptcies and consolidation gathering pace before the consumer side would really feel the effects of that. And then to your second question, climate shift, promoting shale over deep water, I would say yes to an extent. And again, I use the shale and the deep water just as like far extreme examples across what is very much a continuum of the time and capital required to develop various projects. So everything from onshore traditional to shallow water and everything else to more I guess frontier areas that it's still a conventional play. Each of those, I think, will face a range of the same challenges, but the two extremes, shale and deep water, I think exemplify how that continuum plays out across the range. So my view is the nearer you are toward the shale end of speed and relatively low capital cost, the less pressure you'll be facing from the climate transition. And the closer you are toward the deep water end of very long-term, very high capital cost, the more pressure you'll be feeling.
No, that's great. It's extremely useful in that graphic. Look at the laying out the timeline and when the 2050 comes into play, and then especially with the internal combustion engine and those policy elements that, like you said, have already started to take shape. Let's turn to national oil companies. We've got two questions here. I think this is fantastic, specifically as we look at Latin America specifically. So you can see the question here. Thank you, Igor, and thank you, Rafael. So what are the roles of national oil companies in the future? Obviously, most of the countries in Latin America, Pemex, Petrobras, YPF, you go down the list, Ecopetrol. Are we going to see similar commitments from those NOCs in terms of emissions goals, in terms of emissions reduction efforts? Similar, that is, to the IOCs. Are NOCs more constrained? What kind of diversification strategies, cleaner products? And then the broader question that Rafael complements it with is, are they reacting to everything you've talked about in terms of the low carbon energy transition?
Yeah, no, excellent questions. And I would say, as far as, would we expect a similar level of commitment to emission goals? I would say that depends entirely on the domestic politics of the country and the state that they represent. So for example, it's sometimes easy to forget that Equinor is essentially a state-owned company, right? It was very much so back when it was going by another name. And yet, being a Norwegian company, it is very much responsive to broader Norwegian government goals and Norwegian public's concern about climate change and moving towards zero emissions. And so you see that company having a very different response than, say, a national oil company in the Middle East, for example. So I would say, as the politics change, and I think this touches into that concept of being a generational issue, as the domestic politics and what the political constituencies expect from their governments, I think you will see increasing pressure on NOCs as well to be, part of transition rather than working at crossways to it. And that can take the role in reducing emissions and increasing efficiency in their own operations. But to I think later on in Igor's question there, his point, it can also be sort of market responsive. So as these companies need to respond to changing demand for various products, making sure that their ability to provide that different product slate keeps pace with that shift in demand. And there again, I think some companies will have an easier time of that than others. I think one criticism you often hear about national oil companies, even though there's a wide range, is that they tend to be less nimble. They tend to be slower to change than private companies, in part because of their government structure and the restraints that are put on them by their political overseers. And so if that remains true, then you may see national oil companies struggling to keep pace with shifting requirements and demand, especially if there's a need to invest in upgrading their infrastructure and their ability to produce those products that are then required.
You hit on something, and I'll selflessly promote the webinar series here, but relate it back to something you just got done saying. I mean, we had a webinar with YPF, the Argentine quote unquote national oil company, quote unquote, because it is large. You know, it's majority owned by our state of Argentina, nation of Argentina, but it still has significant private investment. The point I want to make is the person who presented in that webinar spoke exactly about these issues and how YPF was positioning itself, what they were doing in their entire value chain to address emissions, as well as to begin to develop some diversification efforts, YPF lose and the renewable business. But exactly what you said, Jed, we've now seen a macroeconomic crisis in Argentina, a changing government. And I would argue that pretty much everything that was laid out is on hold or potentially on hold, given the broader macroeconomic and macro political environment in Argentina. So it does seem to me that the NOCs, when they're majority owned by the nation, do end up getting sucked, as you note, very much into the domestic discourse. And that is so much more a driver of what their strategies and objectives end up being.
Mm-hmm. Yeah, no, definitely. And like I said, to build on one of the points you made there, and I think this touches on the question as well. You know, thinking about oil companies, whether private or nationally owned, and their role in the transition itself. You know, as you noted, I think in the introduction, these oil companies, especially the private sector, are increasingly announcing renewable energy investment, renewable energy targets, and their goals to sort of shift away from oil toward becoming more broader energy companies. And what I find fascinating about that is that's been done before, right? I mean, 10, 15, 20 years ago, there's a lot of talk about renewables, and even BP became beyond petroleum. And it was seen as a little bit premature, right? It was not, it didn't get the response at the stock market that they hoped. And the hard truth is, because currently today there are very few things you can do that make as much money as pumping oil, right? Software and pharmaceuticals come to mind, but there's not a lot else out there, and certainly not clean energy. There's a lot of great companies that are involved in it, but they don't have the margins that an oil company does. And if you're already an oil company, telling your shareholders, we're going to walk away from this money machine and do something different is difficult. I think what's making that transition, that conversation easier, is this generational shift in attitudes. So it's increasingly more what shareholders and others want to hear. But also, I think what will make it easier is if the pot of money that's available by making oil begins to shrink, and either that's through the drop in demand, or if costs continue to climb significantly, whether through natural means or through regulatory means of the carbon price and the rest. As that starts to squeeze margins, it becomes much more rational and easier for the oil company CFO to say, hey, we're moving away because we can do just as well somewhere else.
You bring up something there I want to come back to, but carbon tax. I want to get your thoughts on where are we on a carbon tax, because it seems like there's been some movement, but I'd like you to comment. But you also hinted something here that I want you to opine on, and it seems to me there's still a gap between sort of what I would call European companies. You mentioned Equinor for one, and U.S. based companies. I mean, there was a recent comment from a U.S. company saying that they're not interested in getting engaged in a beauty contest with reference to the emissions reduction objective targets. Some of the other companies. Do you agree? Is there a gap between what we could argue European or European-based companies vis-a-vis U.S. companies?
Mm-hmm. Yeah, no, that's a good point. I mean, I would observe that there's a spectrum of sort of what companies are saying and what they're doing, and often those two align, but not always. And there's a range in each of those, right? I do believe that European companies tend to be more toward the proactive side of certainly announcing and promoting their green credentials, but also putting money behind that. But I think it's similar to what we see in what I mentioned earlier about national oil companies. It's companies responding to their constituencies and their sort of perceived customers and those that can affect their license to operate. So it's not as direct or as strong a pressure as a national oil company would feel, but I think there is certainly a different environment to operate in if you're a European oil company than if you're a US one, even though it's a global market.
And, yeah, and so to that end, I mean, take it to the question: where are we? I know we're almost out of time here, but just in 30 seconds, carbon tax, carbon price.
Yeah, no, I agree. Like, I feel like there is movement. I feel like getting to a consistent and evenly applied global carbon tax, which is, I think, what is desperately needed, is still extremely difficult. And I guess, again, in a nutshell, I think the path that we're going to see is sort of the more progressive countries, especially Scandinavia, parts of Europe, will, I think, move forward with some form of carbon tax with a border import-export truing up to try and make sure that their domestic companies are on an even footing with global providers, whether it's oil or other products. And then that will be challenged, and what's left of the World Trade Organization may or may not weigh in, and slowly it will expand. But I think it's going to take a lot of time, and possibly time that we don't have if a lot of these countries are moving toward net zero by 2050.
That's yeah. By the time they actually,
yeah, by the time it actually bites, if it takes 10 years to figure things out, then we're already a long way toward that target.
well, we're unfortunately out of time. I have about 10 more questions. Unfortunately, I'm not going to get to them, and I want to let everyone go. We set to wrap this at 11 a.m. California time, and it's 11:01. So I want to thank you again, Jed. But as everyone who follows us and participates in our events knows, I always love to end with a yes or no question. And I couldn't help but take note of your statement about Mexico. And obviously, Mexico is a place you follow closely, and you and I have interacted a lot in Mexico. Your comment on Mexico's cancellation of the auctions, permanently closing, I think you called it a window on some of those projects, specifically their attractiveness. So here's my yes or no question, not so much on the auctions, but more broadly. It seems that things are getting to a bit of a tipping point in terms of the economy, in terms of some of the demands in the broader contours of the energy sector in Mexico. Will Mexico reset its energy policy by the end of this year or early next year?
You say if you just ended the question that will Mexico if you just ended with will Mexico reset its energy policy, that is a resounding yes. End of this year, I'm going to say they'll be talking about it.
Okay, we'll take the timeline out of it. Will Mexico reset its energy policy?
Yeah, on the table.
Everyone who participates in our event knows that these questions oftentimes do not elicit a yes or no. Rather, I get a long-winded but, comma, yes over the course of taking into account, therefore.
Yeah.
Excellent. Fantastic. We really appreciate your time. Sorry to put you on the hot seat at the end, but that's what we do. That's fun here. People need to stick around to hear that.
Yep, it's all good. And I thank you again for the invitation. Definitely looking forward to the next one. These are always fun to do.
Thank you very much. Thank you, everyone, for joining us today from all over. We appreciate it. We will download this recording and the slides and get that out to everyone. Have a wonderful day wherever you are. Thank you for joining us.